In Forex trading, most traders focus on charts and news. But there's another powerful layer of analysis that often gets overlooked: market sentiment. Understanding trader sentiment can give you a psychological edge, helping you see where the crowd is leaning and when it might be wrong. Let's break it down. First, what is market sentiment? Market sentiment reflects how traders feel about a currency pair, whether they're bullish, bearish, or uncertain. It's not about data or indicators. It's about collective emotion. When most traders believe the dollar will rise, that's bullish sentiment. When they expect it to fall, that's bearish sentiment. The key: markets often move opposite to extreme sentiment. Because when everyone's already in one direction, there's no one left to push it further. Second, how to measure sentiment in Forex. There are several ways traders track sentiment data. Commitment of Traders CAT report published weekly by the US CFTC. It shows how institutional traders are positioned. If large speculators are heavily long, the trend might be nearing exhaustion. Retail positioning data. Some brokers publish client sentiment showing what percentage of traders are buying or selling. For example, if 80% of traders are long on EUR/USD, it could signal an upcoming reversal. Volatility and option markets. High volatility or rising option premiums can reflect fear or uncertainty. Key sentiment clues: news and social media tone. Headlines, analyst opinions, and even social chatter can show how traders are feeling about a currency or event. Third, how to use sentiment for better predictions. Here's how smart traders use it. Confirm the trend. If sentiment aligns with technical and fundamental signals, it strengthens your confidence. Example: positive sentiment, strong data, and a bullish chart all point in the same direction. Spot reversals early. When sentiment reaches extremes, like 90% of traders being bullish, the market often turns the other way. This is a classic contrarian signal. Gauge market reaction to news. Sometimes, even good news fails to move prices up. That SA sign sentiment was already too optimistic. Example: imagine traders are overly bullish on USD/JPY because of strong US data, but the CAT report shows big institutions cutting long positions. That's your clue that smart money may be preparing for a correction. By watching sentiment, you're not just following the market, you're understanding its mood before the move happens. In summary, market sentiment shows trader psychology. Use data from CAT reports, retail positioning, and volatility trends. Combine sentiment with technical and fundamental analysis for sharper predictions. Extreme sentiment often signals trend reversals or corrections. In Forex, success isn't just about analyzing numbers. It's about reading the emotions behind the market. Mastering sentiment analysis gives you that extra layer of insight that separates reactive traders from strategic ones.